Oh, the holidays. Aren't they the best, bro?
They are the best.
They are. You mean that in all seriousness,
yes.
that this is your favorite time of year.
It is.
And this is the time of year when we get together as family and we turn off our devices and let the noise of the world die down and just enjoy just peace and love and all those wonderful things, right? And we certainly don't freak out about the stock market.
Absolutely not.
Now tell me about one of the Brokamp family traditions that you are bringing to our listeners today.
So on Christmas Eve, there are actually 3 things that happen in the Brokamp household every year. Number 1, everyone gets some sort of sleepwear. It could be pajamas, could be robes, could be onesies. Number 2, we all make food for the reindeer that we make in a nice big bowl. Who knows what goes in it? It's different every year. And then we spread it around. And then number 3, we read 'Twas the Night Before Christmas. So we thought we'd do that here for our listeners.
Yeah, and even though I really love to be attached to my cell phone and see the news that's coming in and stay on top of things, I'm going to set my phone right over here, and I'm not going to look at the headlines. I'm just going to enjoy this holiday moment with you. Bro, can we cue is there some fake fire crackling noises that we could have? Maybe that might be nice. Here we go.
Here we go. Everyone ready?
Are we ready?
Everyone nestled in?
Yep.
Here we go. 'Twas the night before Christmas, and all through the house, not a creature was stirring, not even a...
The Fed, if it keeps hiking rates, will cause a recession. Bro, look at this interview on CNBC. Trump's former economic advisor, Stephen Moore, is saying that we're sunk if the Fed raises rates.
I thought you said we weren't going to look at headlines.
I mean, it was just like a little, I just saw it pop up on my phone. It's just a little, but come on. I need to be freaking out about the Fed raising rates, right?
Well, I would say... not necessarily. First of all, this is what the Fed does and has done since the beginning for over 100 years. It lowers rates during an economic recession, and then it brings the rates back up during the expansion. And we are in quite an expansion, the second longest in history, not that far from being the longest. The current Fed funds rate is only 2.2%. Which is still very low. So right before when they lowered rates and then raised them back up after the dot-com crash, the Fed funds rate got to over 5%. There are times in the 90s it was over 10%. Times in the 80s it was almost 15%. So we're still at a very low Fed funds rate. Are they trying to sort of tamp down things a little bit to keep inflation in check? Absolutely. Will it affect the economy? Will it possibly affect your stocks? Absolutely. But it won't be catastrophic. And I think it's also important to know that often what is not so good for one part of your portfolio, in this case stocks, can be good for other parts of your portfolio, in this case cash. Because the Fed has been raising rates, we are finally now at a point where earning something. Robinhood just announced they're going to start paying 3% on cash, which is getting up to the historical average. And then the final thing I'll say about this is Stephen Moore is a right-leaning pundit. He's not necessarily an expert, and he has a political agenda for what he says. He's been known somewhat to play fast and loose with the facts, and you could choose a pundit from anywhere along the political spectrum. You could say the same thing about them. So whenever you see a headline from someone with a political agenda, just take it with a big grain of salt.
Okay. All right. You can keep reading. I'll put my phone aside.
Okay. All right, everyone. Here we go. The stockings were hung by the chimney with care in hopes that St. Nicholas soon would be there. The children were nestled all snug in their beds while...
The housing boom is already gigantic. How can it last? Bro, look at what Robert Shiller wrote for the New York Times. He says we are experiencing one of the greatest housing booms in United States history. How long will it last? And where is it headed? Next to impossible to know. If Shiller doesn't know, no one knows.
Well, indeed, the Nobel Prize winning Shiller is a bit of a smarty pants when it comes to these things. He's the co-founder or co-creator of the Case-Shiller Housing Index, known for sort of anticipating the dot-com bubble and crash as well as the housing bubble and crash. So whenever Robert Shiller says something, I pay attention. And coincidentally, I read this same article.
And you didn't freak out like me, or you did freak out?
I did not freak out like you. But here are the facts. So since housing prices bottomed in 2012, they've gone up 53% nationwide. Adjusted for inflation, it's a little less than 40%. That's a big jump over a span of about 7 years or so. And he points out that this is the third biggest boom in history. The biggest was the one we went through that ended in 2006, and it was followed by a 35% crash in home prices as well as the Great Recession. The other time was from 1942 to 1947, end of World War II, GIs coming home, baby boom and stuff like that. But after that, housing prices actually didn't crash. And if you read Calculated Risk, which is a blog by Bill McBride, which is my favorite economics blog, he points out that if you look at different statistics, different historical information for housing booms and busts, he finds that there are a couple other that are actually bigger price increases than what we've seen in the 70s and 80s. And in those times, housing prices didn't crash. So I'm not too worried about it. Really, I think a lot of our perception about home prices has been colored by what happened during the Great Recession. And it was very unique because it was the first nationwide crash in housing prices, but it was also unique because it was the only time when housing prices declined and the stock market declined. There's research from Mark Holbert that looked at the 20 bear markets in the stock markets over the last 65 years. He actually found that when stocks go down, home prices tend to go up. So historically, in most cases, home prices are actually a good hedge against stock prices. So I'm not too concerned about it. When it comes to housing, I always look at it as an asset, not an investment, meaning it is something that I put on my balance sheet. It is something that you can definitely use in retirement, whether by downsizing or as a reverse mortgage. But I don't look at it as an investment. I don't get too concerned about whether my home price is up or down. I just look at it as something as long as it fits within my budget, I enjoy it and know that in the future I can use it if I need it.
Okay. All right. I guess I feel a little bit better and more peaceful now.
Well, that's good.
You can keep going.
Okay. All right, here we go. And Mama in her kerchief and I in my cap had just settled our brains for a long winter's night. When what to my wondering eyes did appear but a miniature sleigh and
a bear market is already here for most major global stocks. Bro, this article from Bloomberg says that 52% of companies in the MSCI World Index are down by more than 20% from their 52-week high.
Wow. Well, that's a very...
Oh, wait, did that shake you? Did that actually rattle you a little bit?
No, not necessarily. So this index looks at stocks all over the world, including the U.S. And when you look at the U.S., as of the taping of this episode, which is December 14th, the S&P 500 is down a little bit on a price basis, but when you throw in dividends, it's about flat. Small caps and mid caps are a little lower. They're down about 5% for the year. But when you look internationally, it's been a rougher year. International stocks are down from anywhere from 12 to 15%, depending on what you're looking at. The worst countries this year are Turkey and Russia. They're down 20%. And these are the indexes. And most indexes are weighted by market cap, which means they're strongly influenced by the biggest companies. What this article did was look at all the stocks individually. And it's true that the majority of stocks are actually down 20%, which by definition is bear market territory. So am I concerned about that? Not necessarily, because when stocks go down, they're better values. A recent article in the Wall Street Journal found that globally, stocks are now valuation-wise at 5-year lows. Lower valuations means higher prospective future returns, which is always a nice thing. But it also shows the need for diversification. This year, international stocks are lagging U.S. stocks. 2017, it was the opposite. International stocks greatly outperformed. So I'm not too worried when I have some things that are doing okay, some things are up, like cash, and something is down significantly, because that's what happens with a diversified portfolio. One of my favorite quotes about asset allocation comes from
there's so many to choose
It's a
from.
Tough choice. But this one comes from a financial advisor in Pennsylvania named Lou Stanislawicz, and he says, if you're not losing money somewhere in your portfolio, you're not diversified enough. So I'm okay with some things being down, especially in the context of where we've been. Over the last 10 years, the S&P 500 has grown something like 14% a year. Even international stocks have grown 8% a year. We've had a really good run. It's okay for things to take a little bit of a break.
Okay. All right. I feel a little better.
Do you? Good.
Yeah.
Glad to hear that.
All right. I guess you can keep going.
All right. Here we go. With a little old driver so lively and quick, I knew in a moment he must be St. Nick. He was chubby and plump, a right jolly old elf.
So much for the Santa rally. Trump's trade war is sending the S&P 500 toward its worst December since 2002. Bro, even Santa can't save us. Look at this headline from Business Insider. It says that we're going to have the worst December in 16 years and that there will be no Santa rally this year. Look at this sad photo of a sad man in a sad suit and a Santa hat. There's just too much sad. The hat isn't enough.
I looked at the picture, and I think it's Art Cashin. So those of you who know Art Cashin from UBS, I think. He's on CNBC every day. Just imagine him sad in a Santa hat. So here's the deal, right? So December traditionally is actually a really good month in terms of its average annual return, but also it is the best month in terms of percentages with a gain. Since 1950, December has made money 75% of the time. So at this point in December, halfway through, we're actually down 5.5%. So that is a bit of a shock. But that's where that 25% comes in. And the lesson, of course, is regardless of what's happened in the past, the future can always be different, or something that is historically a low probability event can happen. Now, that said, we do have the Santa rally. Now, the Santa rally technically happens the last 5 trading days after Christmas.
Oh.
And then the first 2 trading days of January.
We got time.
We've got time to recover. And historically, this was discovered in 1969 by the guy who writes the Stock Traders Almanac. And the Santa rally makes money something like 80% of the time. So who knows? We still might end up with a good December, which would then make at least the S&P 500 put us in positive territory for the year. But we don't know if that's going to happen. So you just kind of hold on through it. If there's money you need to spend at the end of December, you should probably have it in cash. But generally speaking, I don't pay much attention to what might happen or what might not happen from month to month, because I'm not going to retire for another 20 years, and that's all I care about.
Okay, I do feel a lot better.
Do you feel
and
a
it's
lot
not
better?
just the eggnog kicking in. Let's finish it. Take us home, bro.
All right, here we go. He sprang to his sleigh, to his team gave a whistle, and away they all flew like the down of a thistle. But I heard him exclaim ere he drove out of sight, "Happy Christmas to all, and to all a good night."